It's that time of year again. My phone is blowing up every December. I get the same calls from investors who suddenly realize they're about to get crushed on taxes. And now they're panicking because they want to fix everything before December 31st. And you can imagine what they say. Mikey, do you have a real estate deal I can throw money into so that I can get some depreciation before the end of the year? And here's the truth. 1, I love them. 2, this is actually the worst way to invest in real estate. When you're desperate for a tax deduction, you're no longer looking for a great investment. You're basically just trying to stop the bleed. And that's where people make their most expensive mistakes. So instead of waiting until December and freaking out, I'm going to walk you through 7 strategies you can use to legally reduce your tax bill. And the best part is, most of these things you can plan for right now so that you're not in the same situation next year. And stick around to the end because the 7th strategy is the one that most people mess up on. And if you get it wrong, it will cost you way more than it saves you. Let's get into it. Strategy number 1 is simple, but most people ignore it. Max out your retirement accounts, your 401k, your IRA, your SEP IRA if you're self-employed, and your HSA. If you're making good money, you're probably in the 24 to 37% tax bracket. So every dollar you put into a traditional retirement account reduces your taxable income by that same percentage. In 2025, you can contribute up to $23,500 into your 401k. If you're in the 32% bracket, that one move saves you over $7,000 in taxes. If you're self-employed, you can potentially put away even more with a SEP IRA or a solo 401k. A SEP IRA lets you contribute up to 25% of your net self-employment income, up to a maximum of $69,000 in 2024. The 2025 limit will likely increase. And don't forget about HSAs. These are triple tax advantaged. Money goes in pre-tax, grows tax-free, and comes out tax-free for medical expenses. It's one of the most underrated accounts in the entire tax code. Strategy number 2 is a cost segregation with bonus depreciation. And here's the update for 2025. Under the new One Big Beautiful Bill, 100% bonus depreciation is back. That means on qualifying property placed into service after January 19th, 2025, you can deduct the entire cost of eligible short life assets in year 1. Cost segregation is where an engineer breaks your building into components. You have your flooring, your plumbing, electrical, landscaping, and moves large portions into 5, 7, or 15-year property. Then bonus depreciation lets you accelerate those deductions into the first year. And I've seen properties that normally produce $15,000 in annual depreciation turn into $100,000 or more in year 1 when you combine a cost seg and bonus depreciation. A study usually costs $5,000 to $10,000, but the tax savings are often massive. Just make sure you use a qualified firm. Strategy number 3 is tax loss harvesting and portfolio rebalancing. One of the simplest and most overlooked tax strategies out there, and you don't need to be a Wall Street investor to benefit from this. If you own stocks, crypto, index funds, really anything with gains and losses, this applies to you. Here's how it works. If you have an investment that's down, maybe a stock you bought high during COVID, or a crypto position that took a hit, you can sell those positions, lock in the loss, and use that loss to offset your gains for the year. So let's say you made $50,000 selling a winning investment. If you have another position that's down $50,000 and you sell it, those two cancel out. Your capital gains tax bill can drop all the way to 0. And here's the part that most people don't realize. If you still believe in that investment long term, you can buy something similar, not identical, but similar. So you stay in the market without violating the wash sale rule. Or with crypto, the wash sale rule doesn't apply at all. So you can sell it for a loss and buy it back immediately. This is literally one of the easiest tax strategies available, and almost nobody uses it correctly. So now let's talk about rebalancing. Every year, your portfolio drifts. Your winners grow and your losers potentially shrink, and your entire risk profile changes without you even noticing. Tax loss harvesting gives you the perfect chance to reset everything. Sell your losses, offset your gains, and rebalance back into the long-term strategy you actually want. It's simple, it's clean, and it saves people thousands of dollars every single year. You don't need to wait for your CPA to tell you this. You can start planning for it right now. Strategy number 4 is real estate professional status, reps. This is the holy grail for real estate taxation. And not everyone can qualify, but this is how it works. Normally, rental loss is passive, so you cannot use that to offset your W-2 or your business income. But if you or your spouse qualify as a real estate professional, those losses become active. And now you can use them to offset your other income. And here's how you qualify. You need to hit 2 tests. Number 1, at least 750 hours of real estate activity per year. And number 2, more than 50% of your total working hours must be in real estate. And this is heavily audited. So you need logs, calendars, documentation. But if you qualify, the tax benefits can be 6 figures or more. And it's absolutely legal. You just have to follow the rules. Strategy number 5 is using donor advised funds for charitable giving. This is something I've been using for years. If you're planning to donate anyway, you can front load your giving into a single year to maximize your deduction. So instead of giving $10,000 per year, maybe you contribute $50,000 or $100,000 into a donor advised fund year 1. You get the entire deduction that year, but you can distribute the money to charities over time. And here's the advanced move. You can donate appreciated stocks instead of cash. So if you bought a stock for $20,000 and it's now worth $100,000, donating the shares avoids capital gain tax and gives you the deduction for the full $100,000. This is a strategy that wealthy families use all the time. Strategy number 6 is for business owners. Take every legitimate deduction you're allowed. Home office, vehicle expenses, travel, meals, software, education, all of it. But the Augusta Rule is the sleeper move. Under IRS Section 280A, you can rent your home to your business for up to 14 days per year. Your business gets a deduction, and you personally receive that income tax-free. If your business pays $2,000 per day for legitimate events like meetings, planning sessions, or filming days, that's $28,000 tax-free to you and a deduction for your business. But remember, document everything. Invoices, agendas, photos, market rate support. This strategy works, but do not be sloppy with it. And strategy 7 is the 1031 exchange. This is how real estate investors defer taxes over and over and over again. When you sell a property, normally you owe capital gains. With a 1031 exchange, you defer that tax by reinvesting into another property. And if you keep doing this throughout your life and then pass the asset to your heirs, they may receive a step up in basis that wipes out the tax bill entirely. But here's where people ruin it. A 1031 exchange has 2 strict deadlines. You have a 45-day window to identify the replacement properties. You have 180 days to close. Miss either deadline by even 1 day, and the entire exchange is blown. And you can't touch the money. If the sale proceeds hit your account, the exchange is dead. So you have to use a qualified intermediary. Work with a real estate attorney and an experienced intermediary. Do not try to DIY a 1031 exchange. So there you have it. 7 strategies to legally reduce your tax bill without scrambling in December. The tax code rewards certain behaviors: saving for retirement, investing in real estate, as you can see, owning a business, giving to charity. If you understand the rules, you can play the game. But the key is planning ahead. So work with a CPA, work with advisors, and start early. And if you found this helpful, hit the subscribe button, drop a comment with your strategy that you're using to bring that tax bill down. I'll see you next week with more ways to build wealth and keep more of what you earn.